The Mayans are predicting the apocalypse. Our next guest is stopping short of that, but says 2012 could be a transition year, one in which we could see a market bottom. We want to welcome the head of technical analysts for Bank of America, Merrill Lynch. She's widely known on Wall Street. Joining us now, Ann Bartels. You didn't expect a Santa Claus rally for a while now. You haven't been expecting anything big in terms of stock market action, and you have no reason to think the early part, at least, of 2012 is going to be too much brighter.
That's correct, Sarah. What we believe is since August, we've been in a base building process, and we still believe that the October lows need to be tested on the S&P near 1100 to 1074. Now, we haven't ruled out, depending on what happens in Europe, that you can even have a fresh undercut of that low of 1074 between 985 to 934. But we think that's part of the base building process. So we think the first half of 2012 is going to be a rough go, and the second half will be much more bullish.
We're looking right now at the S&P 500 so far this year. 1265 is where we are right now. Give us the next big level.
Well, this is the big level.
Okay.
It's up near the 200-day moving average. Now, volume has been very light, obviously, because we're in a holiday period. So I don't think this is very significant. If we really break through it, we need to see volume confirm. If we did break through, you could have a rally up to the high end of the trading range up near 1300, 1350, but that wouldn't change our mind that you still have to come down and test the October lows.
And we can just pull up that chart again, because you can see that there have been some wild swings throughout the year in the S&P 500. But at the end of the day, we're still looking at a move of 0.6% from where we were at the end of last year.
So save yourself all the headaches and just keep your money under the mattress.
Well, I think if you take a very, very long-term view, a year, 2 years, you'd be very happy if you bought the market today. I think that there are some very attractive companies. In fact, we're seeing some stocks that have traded in a basing range for 10 years. And I think eventually they're going to wake up, and this could be the new leadership that wakes up in the second half. In addition to that, we have a lot of yield, dividend yield within the S&P. We're yield starved, particularly when you look at the Treasury market. And I think if you look at the S&P, you can pick up some very high-quality companies, anywhere between 4 and 6% in terms of dividend yield. So you get paid to wait. So we're cautious on the market because we get paid to forecast the market. But I think longer term, we're going to be fine.
But isn't everyone piling into those dividend payers now, becoming a very crowded trade? We know the PEs of a lot of these defensive companies like healthcare, consumer staples, utilities are now the highest since they've been since 2008. How much more are you going to get from these guys?
Well, there's a lot of yield still in the market that's not that expensive, particularly if you look in healthcare at the pharmaceutical stocks. They're still trading at very attractive PE multiples. So there are pockets. We're not as bullish on the utilities as we are on telecom. Now, you don't get an abundance of stocks to participate, but they're not as expensive as the utilities. There are pockets in the consumer staples market that also are providing nice yield, and even in the energy. So you can really find yield across all the sectors. And so we don't think that investors have really crowded that trade yet. I think we talk about it more than investors have actually participated.
So pick and choose.
Yes, be selective.
We know how important currencies are for stocks. They've been moving in very close directions, at least the euro and the S&P 500. Is 2012 going to be the year of the dollar?
I think the first half of the year is the year of the dollar. If we look at the dollar index, it has a very bullish technical pattern, and we look at the 50-day moving average and the 200-day. The 50-day is now above the 200-day. We call that a golden cross, which is very bullish. And we have the complete opposite on the euro. Golden cross. We have the complete opposite on the euro. So we are concerned that the euro will continue to weaken going into early 2012, and that the dollar is bullish. Now, that's negative for commodities.
And stocks.
I think it creates a lot of volatility as we see the Shanghai and China continue to break down. I think that's a leadership indicator saying that the emerging markets can still have a deeper correction in the early part of 2012. Obviously, this all depends on global growth. If global growth slows more than investors are anticipating, the asset class we're most concerned about is emerging markets, but there's two markets in particular that we're most concerned about, Brazil and India out of the BRIC. And we think China out of the BRIC is the leading indicator, which has already broke important technical support.
China's made it pretty clear that it's more concerned about growth at this point than it is about containing inflation by cutting the reserve ratio requirements for banks. Do you expect more easing measures out of China next year?
I don't forecast that. We have two different views in our house. One is more bullish, one is more not so bullish. I just look at the charts, and what the charts tell me is that there's a problem. And in China, having that index, the Shanghai A-shares, break down and test their 2009 low, to me is very significant. What we're seeing in Europe is the same thing. Many of the markets are testing their 09 lows. The banks are testing their 2009 lows. So that's telling us that there's still concern by investors. The question is, do we have to test our 2009 lows? And I don't think we have to do that on the market, but it is possible that we may have to do that on some of the larger banks.
You're sounding very bearish, Ann Bartels. But what everyone wants to know from you is gold the trade to be in 2012, at least in the early part during all of this turbulence, because we've seen some funky things happening with gold lately.
We've been long-term bulls on gold. We've liked gold since 2004, except now everybody's found the trade. So I am concerned it's a little bit of a crowded trade, and I don't think it's going to be as defensive as it has been in previous cycles. So the risk is that you're in a correction for gold, but we would be buyers. If we saw gold around 1,500, we'd step up and start buying the metal.
All right. Good trading tips from Ann Bartels. She's very well known on Wall Street. It says gold to buy at $1,500 an ounce. Of course, she's the head of U.S. technical market analysis at Bank of America, Merrill Lynch.